I have lived long enough to know that the most dangerous phase of a bubble is rarely the moment of celebration. The truly dangerous phase is the moment when reality stops asking for permission. That is what I believe is happening in housing right now. For the last several years, people have tried to describe the housing market with language that sounds calm, frozen. Stalled, waiting inventory, constrained, rate-sensitive, transaction light. Those phrases are not entirely wrong, but they are incomplete, and incomplete language is one of the favorite hiding places of financial trouble. What we have been living through was not health. It was suspension. Buyers stopped buying because prices and payments no longer made sense. Sellers stopped selling because they were locked into old mortgages and refused to accept what the new math implied. So the market sat there, not healthy, not normal, not clearing, just suspended between fantasy and arithmetic. That is what I would call phase one. And phase one can fool a great many people because prices do not collapse immediately. They hang there, stubborn, elevated, untouched enough that optimists can keep arguing that scarcity still rules the day and that patience will eventually restore the old order. But a suspended market is not the same thing as a stable market. A suspended market is a delayed negotiation. And phase two begins when one side can no longer delay. That is why I want to explain what I think is happening now in 2026, because the housing market has moved into something more serious than a freeze. The data shows it, the psychology shows it, the structure shows it, and while every region will not suffer equally or on the same timetable, the broad shift matters far more than most people appreciate. I want to begin with demand, because demand is the first witness who usually tells the truth. When buyers disappear, they do not always disappear in a dramatic way. At first, they simply hesitate. They tour less, they bid less, they sign less, they ask for more concessions, they take longer to decide. Then eventually the market statistics begin sounding less like slowdown and more like exhaustion. That is where we are now. Existing home sales in January 2026 fell to a seasonally adjusted annual rate of 3.91 million units. That was down 8.4% from December. At the 2021 peak, housing was running at about 6.73 million annualized sales. So we are looking at roughly a 42% decline from peak demand. That is not a mild wobble. That is not an ordinary soft patch. That is a market where the buying side has been materially damaged. And what bothers me more than the level is the duration. We are not talking about one rough quarter. We are not even talking about one bad year. We are now in the fourth year of historically weak demand. Even in prior crises, the movement had a different rhythm. The 2008 era was sharper. This is more like a slow financial abrasion. It keeps wearing the structure down. Then you look at pending home sales, which matter even more because they tell you where signed contracts are going rather than where closed deals have already been recorded. The January 2026 pending home sales reading came in at 70.9. That is the lowest reading in the history of that index going back to 2010. Let that settle for a moment. The forward-looking measure is now weaker than where we were in the aftermath of the last housing disaster. That is not a statistic you brush aside with clever language. Then you turn to time on market. Homes were sitting for roughly 62 to 66 days in January 2026, compared with only 36 days in January 2022. By late 2025, around 70% of all listings nationally had been sitting for 60 days or more without going under contract. In Miami, that figure was around 84.6%. In Austin, about 82.8%. When more than 8 out of 10 listings cannot find a buyer within 2 months, that is not tight inventory acting as support. That is resistance. That is a market where the buyers are telling you something and the sellers are trying not to hear it. The next thing I always want to understand is affordability, because housing is not bought with sentiment alone. It is bought with cash flow. It is bought with income. It is bought with a monthly payment ordinary people can actually survive. And this is where the problem becomes unmistakable. The national median existing home price in January 2026 was around $396,800. A record for that month. Prices are running at roughly 5 times median household income nationally, while the old historical norm was closer to 3.2 times income. At the 2006 bubble peak, that ratio ran in the neighborhood of 5.5 to 7 times depending on the market and the methodology used. In other words, we are once again operating in a zone that should make serious people uncomfortable. The monthly payment is even more revealing depending on the data source. The typical monthly mortgage payment, including taxes and insurance, is running somewhere between about $2,559 and $2,768. According to Redfin, the income needed to afford the median home is around $111,252 a year. That's equivalent now is closer to $83,150. That is a gap of almost $28,000. So when people say housing is expensive, they often make the mistake of saying it too gently. This is not ordinary expensiveness. This is structural exclusion. The typical American household cannot comfortably qualify for the typical American home. That is why first-time buyers are disappearing. Their share of purchases dropped to a record low of about 21%, compared with a historical norm around 40%. The median age of the first-time buyer has climbed to 40 years old. Cash buyers, not financed households, are taking a larger share of the market than ever. This is a massive shift, a housing market that runs increasingly on all. Cash buyers is not a normal middle-class market. It is a bifurcated market. One class is still participating, the other has been locked out. Now, a lot of people hear all this and say, yes, but the Fed has been cutting rates. Surely that will save the market. That sort of thinking is one of the most dangerous habits in finance. It takes one variable and assigns it magical power. It imagines a complicated market can be rescued by one policy lever, even after the underlying structure has become badly unbalanced. The Federal Reserve has cut rates 6 times since September 2024, about 175 basis points in total, taking the federal funds rate from around 5.5% down to about 3.75%. The public was taught to believe this would revive housing demand. It did not. The 30-year mortgage rate barely cooperated. It was about 6.5% when the cut started, and today is still around 6.01%, according to Fannie Mae. After the first 3 cuts, mortgage rates actually went back above 7% for a time. That tells you something very important. The market is no longer broken because rates were too high in the simplest sense. The market is broken because prices remain too high relative to incomes, while financing relief is too small to restore true affordability. This distinction matters. If the problem were purely the cost of debt, rate cuts would be far more effective. If the problem is that prices are wrong, then cheaper policy alone cannot solve it. You need repricing. And repricing is what owners and industry people spend years trying to avoid. That is why the market froze. And that is why Phase 2 matters so much. Before I define it plainly, I want to discuss negative equity. Because this is where housing starts moving from uncomfortable into dangerous. According to the February 2026 ICE Mortgage Monitor, about 1.1 million borrowers ended 2025 underwater on their mortgage. That is the highest since early 2018 and about 2.1% of all mortgages. At the start of 2025, there were around 696,000 underwater borrowers. So within 1 year, the count jumped around 58%. That should get your attention. And there is another layer. Around 3.2 million borrowers have less than 10% equity. That means they are not fully underwater yet, but they are standing on thin ice. A 5 to 10% price decline in the wrong market can push millions more into negative territory. The composition of this distress is even more revealing. More than 90% of the currently underwater homeowners bought between 2022 and 2025. These are recent buyers, peak-era buyers, people who entered late, often with high payments, limited equity cushions, and an assumption that housing would remain stable enough for time to do the repair work. Time may not be willing to do that repair work quickly enough. Cotality reported that total borrower equity declined by about $373.8 billion, with the average homeowner losing around $13,400 in a single year. And the concentration is not random. Lakeland, Florida is around 10.8% underwater, Cape Coral, roughly 10.1%, Austin around 9.2%, and still roughly 27.8% below its 2022 peak. San Antonio, around 8.8%, Tampa, Colorado Springs, and other Sunday Belt markets are also under pressure. And then there is the FHA problem. This is where the surface statistics can fool people into false comfort. People say the national underwater rate is nowhere near 2008. True, back then it reached somewhere around 23 to 26%, more than 11 million households. Today we are around 1.1 million underwater borrowers. But that comparison can make people lazy because they forget how 2008 actually developed. It did not begin with every region collapsing simultaneously. It began in pockets. It began in specific vintages. It began among weaker credit structures and thinner equity buyers. That is exactly what we are seeing again in certain places. In Cape Coral, nearly 70% of 2023 and 2024 vintage FHA loans are underwater. In Austin, around 65% of 2022 vintage FHA loans are underwater. These are not healthy numbers. These are not ordinary little fluctuations. These are the kinds of numbers that tell you where the first forced sellers are likely to come from when life events begin pressing on households that do not have much equity to defend them. And once forced selling begins, housing changes character. That is the whole difference between Phase 1 and Phase 2. Phase 1 was the freeze. Nobody wanted to transact on honest terms. Buyers could not afford the prices. Sellers did not want to accept the new reality. Owners with 3% mortgages stayed put because the existing financing was too good to surrender voluntarily. Volume collapsed, but listings did not flood the market because owners with strong equity and cheap debt had room to wait. That was the standoff. Phase 2 begins when sellers lose the luxury of waiting. This is what the source material captures so well and what most people still are not fully discussing. Phase 2 is not just low demand, it is low demand meeting rising compulsion. And compulsion is what changes prices. A market does not need broad panic to reprice. It only needs enough owners who have to move, have to refinance, have to absorb a loss, have to deal with a divorce, a job loss, an insurance spike, an HOA special assessment, a maturing loan, or a mounting payment burden they can no longer carry. That is where we are moving. The lock, in effect, is weakening. More mortgages above 6% now exist than mortgages below 3%. That means the magical protection of the ultra-low rate era is fading in importance at the margin. People who bought in 2022 through 2025 are often carrying housing costs equal to 35 to 40% of income. They are much more fragile than the households who refinanced into ultra-low fixed rates years earlier. When fragile owners meet life events, they do not get to hold out forever for yesterday's prices. They have to act. And if they are underwater or close to it, their options narrow fast. This is why negative equity is so corrosive. It does not merely reflect distress, it creates it. A seller with healthy equity can cut the price and still move on. A seller with no equity has far fewer graceful exits. That is how short sales, delayed defaults, negotiation stress, and emotional denial start entering the picture. Then the process feeds on itself. One loss becomes the comp that drags the next appraisal down. One forced sale becomes a reference point. One reduction makes the next seller more anxious. This is what people mean when they say housing is local, and it is true. But local markets still teach the same structural lesson. Once enough forced action arrives, the market begins clearing lower whether the owners emotionally consent or not. Now I want to talk about geography because not every region is in the same stage. The Sunday Belt has the clearest visible correction already underway. Florida, Texas, Arizona, Colorado. Those are not abstractions. Those are places where the inventory, price cuts, migration shifts, insurance burdens, and distress financing are already combining into something much more serious than a mild normalization. Florida is especially instructive. Inventory there has surged to more than 200,000 homes for sale, around 42% above 2019 levels, with roughly 8 months of supply. Texas is around 151,769 homes for sale, about 48% above 2019, with roughly 7 months of supply. That is not tight. That is swollen. Price cuts are widespread. Nationally, about 34.2% of listings have taken price reductions. About 62% of buyers are paying less than asking. Typical discounts below list are around 7.9%. The largest since 2012. Sellers are not holding the line in the way they once imagined. A growing share are retreating, cutting, or delisting. Delistings themselves are a sign of stress, not health. In Miami, there were about 59 delistings for every 100 new listings. That tells you some sellers are not accepting current bids, but it also tells you the market is failing to clear in an orderly way. Redfin reports there are now roughly 37.2% more sellers than buyers nationally, the largest gap in their records going back to 2013. That matters because housing is very different depending on which side of that ratio you are standing for years. Sellers had psychological power, now that relationship is changing, and the condo market in Florida is an even sharper warning. Median condo prices there dropped around 8.1% year over year, the biggest decline since 2010. Inventory exploded by roughly 35 to 37% post. Surfside legislation requiring structural inspections for older buildings has created real economic pain for hundreds of thousands of units. Special assessments of $20,000 to $50,000 per unit are becoming common. Condo associations are on Fannie Mae's financing blacklist. This is not abstract macro theory. This is direct household math. A unit that once looked affordable suddenly comes with a surprise bill large enough to wreck the economics for an owner or to frighten off new buyers entirely. That is exactly how markets move from suspended to forced. People can ignore headlines for a long time. They cannot ignore a $30,000 assessment or a payment they can no longer carry. Now, some people look at the Northeast and Midwest and say, those markets are safe, and for the moment some of them are less visibly stressed because supply remains much tighter there. Chicago, New York, Hartford, parts of the Midwest and Northeast still show positive year price gains. Inventory remains 40 to 60% below 2019 levels in some of those places. Supply constraint still matters, but I do not like using the word safe too casually. A market can be supply constrained and still become risky if price keeps rising while population and migration trends weaken. New York lost roughly 137,000 net domestic migrants in 2025. Illinois remains a population loser. New Jersey and Massachusetts are still bleeding residents on a net domestic basis when prices rise in shrinking or stagnant population markets. The market may still function for a while because inventory is low, but the margin of safety narrows A place can look stable and still be vulnerable if affordability stretches far beyond what local demand fundamentals justify. That is why I would not call those markets immune. I would call them later cycle. The reason Austin can be nearly 28% below peak while Hartford sits more than 21% above its 2022 level does not mean Hartford discovered new laws of finance. It means different stages of the same negotiation are unfolding in different places. Ultimately, those differences matter. Overvaluation paired with population loss is not a comforting long-term mix. Now, I want to bring in the other large force sitting behind all this, which is debt maturity and the commercial real estate overhang. Over $930 billion in commercial real estate loans mature in 2026. About 60% of the most distressed apartment loans come due in the second half of the year. That is a very large wall. And debt walls are not solved with optimism. They are solved with refinancing, fresh equity, asset sales, or default. If refinancing is expensive, if occupancy is weaker, if valuations are down, and if lenders are more cautious, then the system is forced into uglier choices. A lot of people still talk about commercial real estate as if it were a separate story from housing. I do not think that is wise. The financial system is connected. Regional banks carry exposure. Apartment supply affects rents. Investor psychology does not remain neatly separated between single-family, multifamily, and commercial categories once stress begins accumulating. Forced sales are forced sales, and forced sales always matter more than the crowd wants to admit early on. Then there is migration. This is one of the most underappreciated parts of the whole setup. The Sunday Belt boom was not just about cheap money. It was also about people moving in, people bringing income, demand, household formation, and price support. But that migration engine has weakened dramatically. Florida went from roughly 310,000 net domestic movers in 2022 to just around 22,000 in 2025. That is about a 93% collapse. Texas fell roughly 70% from around 222,000 to about 67,000. International migration into the United States has also fallen sharply. And that matters more than many people think, because when builders expanded supply and owners priced homes aggressively, they were not merely betting on rates. They were betting on continued inflows of people. Take away the people and the economics change very fast. Without new households, you do not clear the new inventory. Without fresh demand, the high prices become harder to defend. Without migration, the Sunday Belt premium starts looking much less secure. This is why I say Phase 2 is different. Phase 1 was still a standoff. Phase 2 is pressure. Pressure from underwater borrowers, pressure from FHA distress, pressure from maturing commercial loans, pressure from vanishing migration, pressure from foreclosure acceleration, pressure from price cuts, pressure from longer days on market, pressure from sellers who now have to act. This is not theoretical anymore. Foreclosures are accelerating. Filings were up about 14% nationally in 2025. FHA delinquency hit about 11.52%, the highest since 2021. FHA loans represent the majority of seriously delinquent mortgages and an enormous share of the rise in foreclosures. That tells you the distress is not evenly distributed. It is hitting lower income and first-time buyers hardest. That is how housing downturns usually begin, not with the strongest households first. With the thinner equity, thinner income, higher leverage edge of the system. That is the edge that starts leaking before the center admits anything is wrong. I think one of the most dangerous mistakes people make in markets like this is pretending that because something is not yet 2008 in scale, it must therefore be ordinary. Many financial disasters begin looking numerically manageable until they no longer are. At the start of a wildfire, the burning area is always smaller than at the height of the fire. That is not reassuring. It is just chronology. We are very likely still in the early innings of the spread, not the end. Now, I want to speak in a more practical way because I do not like analysis that merely sounds smart and then leaves people helpless. If you are a seller in one of the already weak markets, denial is extremely expensive right now. Austin did not wait for people to agree. It was declining before it declined. Cape Coral did not ask for social permission. Florida condos did not freeze the laws of arithmetic, simply because owners preferred old appraisals. If you actually need to sell, price matters more now than pride. Every month of delay in a market already under pressure can turn into real money. The sellers who are still anchored to peak values are not standing firm. Often they are just volunteering to become stale inventory in a market where stale inventory is increasingly punished. Price aggressively. Now, if the move is real, that may sound harsh. It is much kinder than letting the market teach the lesson later. If you are a buyer, patience has more value than it has had in years. That does not mean every market will collapse. It does not mean any home purchase now is foolish. It means the old habit of assuming you must rush before prices move further away is less reliable than it used to be, especially in the weak Sunday Belt markets. When sellers outnumber buyers, When price cuts are spreading, when negative equity is rising, and when mortgage demand has not responded even after 6 Fed cuts, patience is no longer cowardice. It may be one of the best assets you own, but patient does not mean lazy. Know your market, know inventory, know the specific neighborhood. Know how much of the local demand was migration driven. Know whether condos, single-family homes, or new builds are leading the weakness. Know what the local employment base looks like. Know the local insurance picture. Know the HOA or assessment risk. This is not the time to guess. This is the time to understand. If you are a homeowner who bought recently, the lesson is different. Do not assume time alone will rescue a weak position quickly. Maybe it will, but hoping is not a strategy. If your equity cushion is thin, strengthen the household balance sheet, build liquidity, reduce other debts, protect cash flow. If the market in your area weakens further, what matters most is not the appraised value next month, but whether you can survive long enough not to become a forced seller. That is the key. Housing is not merely a market. It is an obligation structure. People who survive bad housing cycles are often not the ones who guessed perfectly. They are the ones who built enough margin not to be pushed into a bad exit. If you are an investor, then I would tell you something I learned a long time ago. The worst thing you can do in a turning market is use yesterday. S psychology with today S structure. Yesterday was a lock in freeze. Today is increasingly a forced selling setup. Those are not the same environment. A freeze can sustain price illusions. Forced selling cannot. That is why I think phase 2 is a bigger deal than most commentators are willing to admit. It marks the transition from a market that looked strangely calm because nobody would transact to a market where more and more participants are losing the luxury of refusal. And once compulsion enters the system, prices start clearing lower, whether people emotionally like it or not. I want to end with the principle that matters most to me. Housing markets do not break first in the headlines. They break first in the gap between what people owe and what people can actually pay. They break in the gap between list prices and real demand. They break in the gap between yesterday's assumptions and today's cash flow. They break in the places where recent buyers are thinly capitalized, where lenders become less generous, where life events do not wait, and where once voluntary owners become unwilling sellers. That is what I see, not one national cliff, not one uniform crash, something more realistic, and in many ways more dangerous, a wide, uneven, forced repricing that starts in the weakest markets and loan vintages, then spreads wherever affordability, migration, leverage, and denial have been carrying too much of the load. That is why I say phase 2 has begun, and once you understand that, you stop asking the wrong question. The wrong question is this 2008 all over again? The right question is, which parts of the country and which kinds of owners have already crossed from discomfort into compulsion? That is the question that reveals where the real pressure lives. It is also the question that serious people should be asking now before the answers become too expensive to learn the hard way.